The U.S. Federal Reserve Federal Open Market Committee today decided to hold interest rates at the 3.5% to 3.75% target range for a fourth consecutive meeting. Trump has his man in the Federal Reserve at last, but the new tempo of rising prices with inflation close to a 3-year high of 3.8% will be hard for Kevin Warsh to ignore as analysts see higher interest rates by the end of 2026. The European Central Bank also became the first G7 apex bank to raise interest rates as biting inflation returns to the European bloc, kicking off another had-to-ignore trend. While most analysts say that even with a deal, it could take longer for core inflation to come to the 2% target, others argue that the speculation that inflation will remain somewhat elevated for longer could prove inaccurate. It is also still somewhat unclear how long it takes for the crude oil supply chain to normalize and the impact on oil price dynamics. All the uncertainty must have played a part in informing another hold at the FOMC. Still, many FOMC members have already said they could see the need to raise borrowing costs, especially given that the US labor market looks firm and growth outlook decent. Analysts also increasingly are convinced that Trump's call for lower rates will not materially influence the committee decision, which will still have Jerome Powell, Lisa Cook, and a few others who continue to vote independently and lean on the data. Let's listen to Kevin Warsh.
The committee decided to maintain the target range for the Fed funds rate at 3.5% to 3.75%. in support of the Fed's dual mandate. The committee also reaffirmed its policy of maintaining ample reserves in the banking system. Economic activity is expanding at a solid pace, despite elevated uncertainty that owes in part to the conflict in the Middle East. Job gains have kept pace with the workforce, and the unemployment rate has changed little. We recognize that inflation has been running well ahead of the Fed's long-stated inflation goal of 2%. That's been going on for more than 5 years. At any institution, a change in leadership is a natural and timely opportunity to reaffirm its mission, to review current practices, and to consider whether those practices best meet our objectives. My Fed colleagues and I will be working in close collaboration to ask what changes might improve the conduct of monetary policy. On that score, you might have already noticed something, a difference in today's policy statement. It's a bit shorter, a bit simpler, and it dispenses with some older language. That statement just gives you the facts as best we can judge it. Absent also is so-called forward guidance, which we agreed was not well suited to the current policy conjuncture. This afternoon, you also received the usual summary of economic projections. It's been the practice of this committee for participants to submit these projections, and I have encouraged my colleagues to continue to do so. I, however, have refrained from offering any projections of my own, consistent with my long-held views on the SEP, at least as currently structured. In the median projections, real GDP rises at 2.2% this year, 2.3% next year, and total PC inflation runs at 3.6% this year, 2.3% next year. The unemployment rate stands at about 4.3%. The median participant judges that the appropriate federal funds rate to be at 3.8% at the end of this year and 3.6% at the end of next. Let me turn now to a few words on a key initiative that we're announcing today. I'm appointing a task force in each of 5 areas that are central to the broad conduct of monetary policy. First, Fed communications. Second, the Fed's balance sheet. Third, our use and reliance on existing data sources. Fourth, productivity and jobs in an era of transformation. And last, the Fed's inflation frameworks. These subjects are timely, consequential, and in my view, worthy of a fresh look. My colleagues and I discussed them with energy and purpose over the last couple of days. For each of these independent task forces, I'm enlisting some of the very best minds, both inside and outside the economics profession. They will be supported by subject matter specialists from our superb Fed staff. And they'll have a straightforward charge. Start with first principles. Ask hard questions. Examine current practice. Consider alternatives. And ultimately, propose next steps for policymaker consideration. Since last summer, my colleagues discussed possible improvements in the form and function of Fed communications. This new task force will build on that effort, and I expect propose some well-considered changes, including to the SEP I mentioned a few moments ago. The second task force, the one on balance sheet policy, will review the benefits and risks of the current ample reserves regime and the composition of the Fed's balance sheet. They will assess alternative frameworks for the conduct and operation of monetary policy. The third task force, the one on data, will evaluate new information sources and consider methodological changes to improve data gathering, with the aim of giving policymakers more accurate, relevant, contemporaneous, and perhaps most important, actionable information on the state of our economy. Fourth, the task force on productivity and jobs. It'll survey the pace, the reach, the economic impact of new general purpose technologies, including AI, and explore the implications for the Fed in pursuit of our employment and inflation mandates. The last task force, the one on inflation frameworks, that'll examine the drivers of inflation, first principles, and weigh the full range of ideas for delivering price stability in a changing economy.
Hello and welcome to Global Business Insights, where we bring perspectives to help you understand an increasingly complex terrain. To other stories, China's retail sales fell 0.6% year-on-year in May, the first decline since 2022, while urban fixed asset investment dropped 4.1% in the first 5 months compared to 2025. Manufacturing was stronger, up 4.5% from last April, but China's export-led growth model looks increasingly fragile. The British pound fell further against the US dollar today after UK inflation held at 2.8% year-on-year in May. Monthly inflation slowed to 0.2%, below the 0.4% forecast and April's 0.7%, while core CPI rose to 2.6% year-on-year, also under the 2.7% consensus. The reading supports the Bank of England keeping interest rates on hold in coming months. How much influence can the G7 still exert on business amid trade tensions, Asia's rise, the US-Iran conflict, and the unresolved Ukraine-Russia war, all straining the group's unity? The world has shifted far from the G7 original vision, with new power centers emerging and old assumptions under strain. As leaders meet in Evian-les-Bains, France, breakthroughs look unlikely. Simply convening may just be enough, with no strong consensus or joint communiqué expected. Emmanuel Macron hosts US President Donald Trump today for an elaborate dinner at Versailles Palace, marking 250 years of US independence and recalling the 1783 Treaty of Paris that officially recognized US independence, which also was signed there. Brent fell as much as 3.9% in London yesterday after reports that a ceasefire and Hormuz reopening deal could be signed on Friday in Switzerland. Prices dropped below $80 for the first time since early March on renewed hopes, while some risk premium is expected to remain. Producers now aim to raise output as demand rises and inventories stay depleted. A draft memorandum states Iran will never produce nuclear weapons, opening 60 days of talks, which includes regional partners' role in a $300 billion plan to rehabilitate Iran's economy. No US funds will be involved, while the performance-based agreement provides for lifting sanctions as Iran complies with the ceasefire deal. South Africa's inflation rose for a third month to 4.5% in May 2026, the highest since July 2024, but below the 4.7% forecast. Transport and housing costs led the increase, driven by higher fuel prices linked to the Middle East conflict and Eskom's latest electricity tariff hike. The print helps the case for another rate hike when the South African Reserve Bank policy meeting holds in July. Our last story is on the latest Nigeria May inflation print. Nigeria's headline inflation rate went up, albeit marginally, from 15.7% in April to 15.9% in May 2026. The May print came in lower than Bloomberg median estimate of 16.2%. Analysts expect price pressures to ease further as oil prices continue to slide in anticipation of Friday's signing of an agreement to reopen the Strait of Hormuz, which helps a disinflation trend. The Central Bank Monetary Policy Committee, which held the benchmark rate at 26.5% in May, meets next on July the 21st. CBN Governor Olayemi Cardoso at the last meeting saw an environment expected to support a return to disinflation, and the drop in crude, more than 5% after the latest deal announcement, could be the driver to cap rising prices. The chances of seeing resumption of rate cuts later in the year are now higher as elevated shipping costs and disruptions to global supply chains could abate as risk premium also broadly heads south. Looking at other details, core inflation, which strips out farm produce and energy costs, rose to 16.8% from 15.9%. Same with food prices, up 16.96% from 16.1%. There is also some hint at disinflationary pressures as both headline and food inflation moderated on a month-on-month basis. Headline month-on-month inflation dropped from 2.13% to 1.75%, while food inflation month-on-month eased from 3.63% to 2.98%. Dr. Muda Lawal, Director, Chief Executive Officer, Center for the Promotion of Private Enterprise, commented in a recent post that at the domestic level, food transportation and energy costs remain the most significant inflation drivers, adding that persistent insecurity in food-producing regions continues to disrupt agricultural production and supply chains, putting pressure on food prices and household welfare. Also, given that inflation is largely cost-driven, addressing insecurity, improving logistics, strengthening transportation infrastructure, and enhancing energy security should remain key policy priorities so costs can come down for goods and services. Well, that's it on this special episode of Global Business Insights. We're now on Spotify, Apple, YouTube podcasts, and most popular platforms where you get your podcasts from. Remember to select the notification button if you subscribe on YouTube. Thanks for watching. Bye-bye.